Carvana has lost a whopping 98% of its value over the last year. Detractors and short sellers believe that Carvana is an irredeemable scam that will go bankrupt within months. But one investor is doubling down and buying more Carvana stock. On top of that, this isn't any random investor. Rather, he boasts a 10-year track record of betting against short sellers and winning. Hi, my name is Maaiz. I'm a hedge fund analyst turned entrepreneur, and on this channel I share the research I'm doing to build the best investment strategies. Cliff Sosin of CAS Capital has averaged a 30% annual return since 2008. Despite his amazing track record, his top investment, Carvana, the online used retailer, is down to $8 from its highs of $375 a share. Just let that sink in. The company has lost $50 billion of value over the last year. At one point, Cliff had nearly half of his entire $2 billion portfolio in this one stock. The question is, will Cliff and CAS Capital prove the short sellers wrong yet again, despite how things may look? Let's take a look at what's under the hood at Carvana and find out. Carvana is the brainchild of Ernie Garcia and his family. The Garcia family also owned the third largest used car retailer, Drive Time, which originally spawned Carvana back in 2012. Early on, Carvana gained notoriety from opening really eye-catching car vending machines in their markets. Since then, they've opened a total of 33 vending machines around the United States. Though the company went public in 2017, they really picked up steam during the pandemic when many used car retailers chose to shut down completely. Carvana took the opportunity to roll out touchless car delivery in March of 2020. They went on to more than double their business that year, growing to be the second largest used car retailer at $5.6 billion in sales. In doing so, the company learned how much their customers valued next-day delivery of their cars, pushing them to continue to reinvest in infrastructure to build out the capabilities to provide speedy sales for most customers. Carvana went on to double sales to $12 billion in 2021 and acquired ADESA used car auctions to better serve customers. This acquisition marked a turn in Carvana's trajectory. In mid-2022, Carvana sales started to slip as a softening used car market paired with rising interest rates led the company to greater than expected losses. In the most recent quarter, Carvana lost $283 million, or $2.67 per share. If you go back a couple of quarters, these losses seem to be the new norm over the last 9 months. On top of that, year over year, Carvana's revenue is now down 8% from $3.48 billion a year ago to $3.39 billion most recently. This is especially hard to swallow after sales had been doubling in the years prior. At the same time, you'll see that Carvana only has about $316 million in cash left on the books. With record losses for 3 quarters in a row and only about 1/4 of cash left in the bank, it is no wonder that the stock is down 98%. The market is predicting that Carvana is going bankrupt. Despite some of these terrible numbers though, if you were to believe management's guidance and attitude amid this breakdown in the business, the stock wouldn't be trading at 1/3 of the price of its major rival, CarMax. There is more behind the scenes leading to Carvana's prodigious decline, and that's where short sellers enter the picture. Stock prices are more than anything a product of the public's view of the future of a company. That future is defined by the story of the company. Often the story is crafted and presented in its absolute perfect version to investors by the company itself. Just think of WeWork or Theranos in the recent past. These companies presented an immaculate vision of their future to investors every chance they got. They also got away with it for the most part due to their status as privately held companies. On the other hand, the beauty of the public markets is there is a financial incentive to pop bubbles in the market. This is called short selling. Short selling is when an investor borrows the stock of a company from another investor and sells that stock on the open market with the hopes of repurchasing the stock back and returning it to the original investor at a lower price and making a profit in the process of doing so. Carvana became a prime target of short sellers once it was trading at many times the value of its largest competitor, CarMax. Carvana skeptics paid for articles and stories to tarnish Carvana's reputation and talk up their failings. The short narrative goes something like this. Carvana has barely ever been profitable and will never be profitable in the future. If you look back at Carvana since the beginning of history, you'll notice they've only had one positive quarter at the peak of the best market used cars have ever seen. Since then, they've continued to lose money in their pursuit to grow faster and faster. Their history of losing money doesn't actually bother me though, mostly because there are countless examples of companies that lost money in the early phases of business to build a market lead. On top of that, when rates were as low as we've seen, this type of investment made perfect sense. This strategy is taken directly from most high-growth behemoths, including Amazon and Uber. And lastly, losing money in the past doesn't mean they'll also lose money in the future. The next claim is Carvana management are crooks that have sold stocks at high prices and bought them at low prices. Specifically, they've sold opportunistically by modifying the selling plan. 2, they also control the company through Class B ownership, where Class B owners have 10 times the amount of voting rights that Class A owners do, like you and I. This, yet again, is kind of pretty common. I looked into the selling and buying of Ernie Garcia and the family over the last couple of years, and it is entirely true that Garcia has bought stock when it was cheap and sold it as it reached new highs. The thing is though, as long as it's done legally, this is a pretty common occurrence. Just take a look at Elon Musk and Tesla. The family selling a portion of the stock doesn't change that they still have much of the family's fortune and future tied up in Carvana. On the other hand, if they were only selling stock, even as the stock was tanking to below cash value, that would be a different story. Turns out that is not the case. Rather, the CEO has bought stock in large amounts when it fell below $25. The third claim is that Carvana makes most of its money from financing to those with low credit. I think this is a fair point. Carvana does make a lot of money from customers with lower credit ratings, and that is part of the reason they have seen a decrease in sales in the most recent quarter. High interest rates have affected those with bad credit the worst. Comparatively, Carvana's sales to higher credit buyers have stayed steady or grown during this time. But most importantly, their ratio of sales made to low credit customers is not that far off from the average, as you can see in this chart. On top of that, Carvana packages and sells these loans forward to banks and other institutions. As a result, they don't carry the risk of these loans failing, but they will sell fewer cars in a bad market. So what is the response to these short sellers? Given all these issues laid out by short sellers, what the heck is one of the smartest investors of the last decade doing buying Carvana as it nears what many are calling an impending bankruptcy? Cliff Sosin's thesis is as follows. First, Carvana has enough cash and cash sources available to make it through more than 1 year of rough quarters. If we open up Carvana's finances, they have about $3 billion of property and credit lines they can still utilize before they run out of money. Bankruptcy is not in the cards anytime soon. Secondarily, they make more money than their competitors per car thanks to their ancillary services and business model. Just take a look at this graph showing their gross profit per unit. Whereas CarMax, the leader in the market, comes in at $2,200, Carvana is sometimes able to make $4,000 or more. Third, they have an amazing record of customers that love the product, with continuing growth in their oldest markets. I think this is the most important point. Despite the many negative articles you might have seen in the news about Carvana, the vast majority of their customers love buying from them. This is most evident in their oldest markets like Phoenix, Arizona, where they continue to grow at high rates, despite much lower marketing spend than newer markets. And despite this success, no competitors have meaningfully entered the online car sales market. On top of that, the cost of acquiring each new customer has decreased meaningfully over time as Carvana has built a word-of-mouth engine for its service. Lastly, Cliff is betting that the management is very shrewd and will be able to maneuver the company to profitability before they run out of money. Carvana's management has put out a plan, and given their ability to execute on their growth plan, Cliff Sosin believes they'll be able to cut costs just as quickly. He takes this one step further and calculates that the company should be easily able to achieve between $1,000 and $2,700 of profit per unit sold. He does this by taking a look at their normalized gross profit per unit and subtracting out mature advertising costs, about $500 looking at the Atlanta market, and the actual SG&A cost per unit back in June of 2022, when they froze hiring for a period of time. Even using the 450,000 units being currently sold and actual costs achieved in the past when Carvana was not optimizing for profits, Carvana should be able to pay its interest expense, assuming the ADESA auction business also continues to earn about $100 million as it has been in past years. So where does that leave us? The truth is, if we take Carvana's numbers and accounting at face value, which it looks like Cliff Sosin does, they really should be able to become profitable in the coming year. The question is whether Ernie Garcia and the remaining Carvana management are up to the task. So far, they've been 100% focused on growth at all costs. And they've done this amazingly well, taking huge market share over the last few years. Will the team be able to pivot to a focus on profitable in 1 year or less? Based on the most recent quarterly results, it's not yet clear they can. Sales were down 8% after growing 100% the previous year. Net income loss was $2.73 per share. At the same time though, they reduced SG&A costs by $90 million just in 1 quarter, all while integrating their acquisition of Odessa, which provides a glimmer of hope that Cliff Sosin might still be right about this stock. It might yet take a few more months for us to know for sure, but if you like this video, check out my video on 5 ways legendary investor Manish Pabrat plans to make a killing in this market.